Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And before we get started today, just a quick reminder about the YouTube live event that I'm hosting at 7 p.m. on the 28th of March. You can register for that event. The link is in the show notes, but it's prosolution.com.au/YouTube. So you can register there. Jared McCabe and I are going to go through the top 5 property mistakes, as in asset selection mistakes. Literally can cost you, really, from a compounding perspective, $1 million or more in terms of future wealth. And the reason that I wanted to conduct this event was because I think it's one of the biggest mistakes that people make. That they unknowingly, mostly, because of course we don't set out to make a massive mistake. But when we're purchasing an asset and we're spending really several hundreds of thousands, possibly millions of dollars on it, we want to make sure that we don't fall foul of some of these mistakes. So I encourage you to register and have a look at that event. Let's hope it all goes well with technology and so forth. Never done a YouTube live event, so wish me luck. All right, let's get into today's Q&A episode. And the first question is from Nick. Nick writes that he's just finished the episode on 25th of March, which was a Q&A episode. And I'll just read what he's written here. You said that you're not concerned with the leverage aspect of holding on to an investment property, but by your own analysis earlier in the series and by traditional share market returns, we need to look at the opportunity cost of holding on to that property. With average market returns being around 10%, why would anyone continue to hold an investment property giving 7% growth as you suggested in the episode? When looking at how much capital growth does a property need to outperform the market, which was an episode, the 5.8% figure came out, and I believe that was fully leveraged. That is, that a property needs to generate at least 5.8% in terms of capital growth to be better than share market investments. And that episode was produced actually by Campbell Wallace. I think I flicked through a few questions similar vein to this, asking, well, what if you put the money towards something else, which I always think is a valuable question to ask. Thanks as always. It's always very thought-provoking. Okay, Nick, it's a great question. And, sorry to any listeners, if the viewpoints in regards to this weren't clear. So I think I remember the question that David asked in that Q&A episode. And the question that he asked was that if I have a investment property that I've held for many years, but no longer has, a material amount of gearing, should I sell it? Which is a good question, right? Especially as Nick, the person just asked this question, highlighted the fact that I have done a number of episodes that have demonstrated that investing in property without gearing is most likely to be inferior to, say, investing in the share market. And gearing adds about half of the returns from property investment. So that's why it wouldn't work without it. And the leverage aspect is incredibly valuable, particularly for people that are just starting out. So that's the real attraction there, is it's probably going to beat share market investments, not because property is better than shares, but just really because of the gearing. So then it stands to logic, I guess, to say that, well, if we're attracted to investing in property for the gearing, when that gearing dissipates, should we go and sell the property? And I guess there's 2 observations there I'd like to share is, firstly, be careful about repaying loans, because some level of gearing against property is actually very efficient, even into retirement. Okay, in retirement, maybe we want to hold a lower level of gearing because we don't have, we're solely reliant upon investment income to service those loans, as is when we're in our working life. Of course, we've got salary and wage income. But even so, some level of gearing is worthwhile. So that's why I've always said interest-only loan, attach an offset, put cash in offset if you want to notionally reduce gearing. But say if I buy $1 million property today, in 10 years, on average, in 10 years it's 2 million, in 20 years it's 4 million. So then in 20 years, I've got $1 million loan against a $4 million asset. So in the initial years of that investment, maybe if I'm concerned about gearing, I'll put money in offset account. But in 20 years' time, I can take that money out of the offset account again and kind of, if you like, in inverted commas, re-gear the asset. So that's one observation, is just be careful about repaying loans, because whilst you might have high gearing levels today, and repaying or offsetting loans makes sense. If we keep those properties for a very long period of time, the reality is the debt against them will eventually become immaterial. And that's a really important thing to really contemplate. Hard to get our heads around because, if we've got $1 million loan against an investment property, it's hard to conceptualize that at some point that $1 million loan is going to seem a lot smaller than it is today. But if I cast my mind back to, say, mid-80s, could have bought a single-fronted Victorian two-bedroom cottage in a great suburb of one of the best suburbs of Melbourne, would have cost you maybe 150 grand. Now, today, that asset's probably worth about $2 million. So $150,000 was a lot of money back in the mid-80s. So it does happen, and we just need to keep that perspective. So really, in answering David's question, which I said to David, look, I'm not too worried that if you don't have a material amount of gearing, I'd keep hanging on to the asset. And the reason I said that is that for that to occur, or what I'm assuming 90% of the time for that to occur, that is, we have an asset that doesn't have a lot of gearing, it means we've held on to the property for a long period of time. So that means, if I go back to my example, buy $1 million property today, it's worth 2 in 10 years, it's worth 4 in 20 years, it's worth 8 million in 30 years' time. So if I've got an $8 million asset, say 30 years from now, and let's say the loan against it, let's say I've repaid the loan, there's no loan against it. Sure, I could go and sell that asset, but 7% of an $8 million asset in terms of capital growth in dollar terms is more money than I'll probably ever need on average, year on year. Whereas I could go and sell the property, pay a huge whack of capital gains tax and reinvest the money somewhere else. Absolutely. And on percentage terms, I might actually be better off doing that. But the sad thing is that, what do they say? Like, when they talk about people buying into a business, that 100% a grape is, less attractive than 10% of a watermelon. That's the whole thing, is you've got this compounding capital growth. And in dollar terms, and remember, we need to finance our retirement in dollar terms, not percentages. So I would say that percentages are important when comparing apples with apples. But of course, you've then got to give consideration to also the opportunity cost of lost growth in capital gains tax, transactional costs, all these sorts of things. Whereas I think dollar value is going to have the greatest impact on your life. So, for example, if I've got that $8 million asset and it's growing at 7%, that means on average, my property is rising in value by $560,000. Now, sure, I can put it into the share market, but the share market's got twice the volatility. So, I could be unlucky and put it in the share market and have, 3 or 4 years of pretty ordinary returns. Plus, also, I've got this asset and it's proven to me that it's generating great returns. So I don't know. I just think if I had an asset that had grown from 1 million to 8 million over a 30-year period, and it was on average rising in value by several hundreds of thousands of dollars a year, I'd just be loath to sell that asset. And I'm probably in a situation 30 years' time where I don't necessarily need to take on more risk. And of course, higher volatility investments are more risk. And that's just the way I sort of think about it. But the flip side to that argument is that you've got a whole lot of wealth built up or trapped in one particular asset. That's not necessarily great as well. And then the other things are going to be thinking about maintenance and land tax. So, the outgoings associated with that property, it's probably not going to be generating a lot of income, and that might not suit your position as well. But I was really answering the question, from a gearing perspective. If I have a great asset that I've held for many years with a lot of unrealized capital gains, and I expect that asset to continue to grow at a very similar capital growth rate, I'm probably going to be loath to sell it. But great question, Nick. And I guess I will acknowledge on percentage terms, if I did it in a spreadsheet on percentage terms, you might, depending on the capital gains tax, you might actually be slightly better off in the long run, but it really doesn't then take into account volatility. And also there's risk, right? There's risk with selling an asset and reinvesting. If I've already got an asset that's performing really well, and I would argue that an asset like that, we probably only need one of those assets to really, together with super, to enjoy a really safe and comfortable retirement, then why would it, if it ain't broke, don't fix it. Anyway, great question, Nick. Sorry for the long-winded answer. Okay, next question is from Brad and Rachel. Brad and Rachel write, "Hi Stuart, love the platform you've given us listeners to learn from each other's questions and answers. Can you please help my wife and I answer this question? What is the point of building a multi-million-dollar property portfolio if you don't plan on selling any properties? Assuming you hold a number of investment grade properties for over 20, 30 years time frame, you'd be in a very strong equity position by retirement age. How do you benefit from that equity and turn it into cash flow? What strategies or ideas do you have that will help property investors harvest the fruits of their portfolio and repay the negative gearing holding costs accrued over such a long period of time? We'd really like other options besides selling. Love the analysis you do. I'm a numbers nerd too." Okay, that's awesome. So thanks very much, Brad and Rachel. Look, it's a really good question. On my list of episode ideas to talk about is one about like how much money is enough. And I think I'll probably chat in the next few weeks. I haven't written it yet. But look, it's my personal viewpoint, mine and my wife's, is that we certainly want to, leave some money behind so that our sons are well looked after. But I think we're going to probably, I'm very confident we're going to tick that box. We'll also leave some money to charity. That's good too. But then what's the point of leaving any more than that? You don't want to, well, we don't want to forego any enjoyment just to leave a larger pot of money to, those two main sort of beneficiaries. So my view then is that you invest slightly more than you need to. So, you need to have a long-term plan and work out, okay, how much do I need to invest so that I'm in a really comfortable position? And a comfortable position could be, the definition of that's going to be different for everyone. Some people are just like, give me $100,000 a year in retirement, I'm happy. Other people, 100,000, but then I want to do some great travel for the first 15 years. So whatever that looks like. So invest enough money, just slightly more money than you need to make that work. So to provide for, any downside in returns. So you don't compromise. Once you've done that, spend the rest is my view. Like if I've worked out, okay, I need to invest $80,000 a year and I'm going to nail my goals and my surplus cash flow is 120, well, that 40,000, as far as my wife and I are concerned, we'll go and spend that money on the things that we enjoy, typically experiences. And so I know Brad doesn't really answer your question directly, but it's sort of a roundabout way of getting there. With respect to building wealth, using property to build wealth, the whole point is you're going to have to sell those assets. There's no magic wand here or way to do it, but that's okay. That's the whole reason that we buy investment grade property assets. That's the whole reason why we sign ourselves up to, financing the negative cash flow, is that the compounding capital growth is going to do all the heavy lifting. And even though we need to sell that asset and pay capital gains tax, I'm contradicting my previous answer a little bit to the question that Nick asked at the beginning of this episode, but that's the whole reason. So the whole reason we're investing is so we can enjoy life in the future or give money to the people that we care about. So there's no magic trick here. I think property does two things. It funds retirement, and the only way it's really going to fund retirement really is when you sell it. So your investment strategy or a investment strategy might include selling property in retirement, hopefully not before. Alternatively, the other purpose of property is to kind of underpin other investments. So for example, if I build a strategy and I think, oh, look, I'm going to have enough share investments and superannuation, I'll probably have enough to fund retirement. But just in case those investments don't work out, I'm going to buy an investment property. And I've always got an asset to fall back upon. So that's the way I think property works in most investment strategies. And I guess the answer is just sell it and enjoy it. And that's the whole, you've worked hard your whole life. You've funded that negative cash flow. At some point, to my mind, you've got to enjoy the fruits of that labor, Brad and Rachel. So it's really invest hard, maybe a little bit more than you need to, and then enjoy the fruits of that labor in the long run. Great question. And thanks for submitting it. Okay, next question is from BM. BM writes, "Thanks so much for selflessly contributing in upskilling the personal financial knowledge for the community through your podcast and blogs. One of my favorite podcasts to listen to in my travels. You also have a great voice, which is soothing to listen to, which is a bonus." Thanks very much, BM. That's good. So just to paraphrase, because it is a long question, essentially BM's asking me, what should he do in his situation? I should say he or she, BM, it's initials, I don't know. Okay, so they're a couple living in Sydney, both 35, with 2-year-old twins with a family income of 370,000, excluding super and bonuses. So 2-year-old twins, I've been there. I've got twin boys, of course. That's good luck with everything there. It's a busy part of life, busy stage of life. So current mortgage is about $1 million. The house, this is against the home. The home value is 1.85 to 1.9, somewhere around that. Also borrowed another 250 to invest in IVV, which is the S&P 500 index ETF, which current value is 300,000, so about a $50,000 surplus there. And in terms of cash flow, they can comfortably save $5,000 to $6,000 each year, and they maximise super contributions. And balance is around 200,000 each, so mid 30s, 200 or 400 in combined super. They're kind of off to the races. Good that you're contributing, but if you keep doing that, you're going to have a substantial balance by the time you get to 60. Okay, so future goals is to have 2 big properties, so 700 square meters of land, worth around 2 million each, and contribute into super, and then also hopefully have a bit of an ETF portfolio outside super. So that's kind of their strategy. Now they're trying to work out what to do with their current home, because their current home is on 400 square meters, and most of the value is represented in the improvements rather than the underlying land value. And so they'd like to buy a property in a good school zone that has a greater land value, and it's going to cost about $2 million. And so what BM's suggested is there's 3 options. Buy a property now in Sydney, but a lower amount because of borrowing capacity. Then it's betting 2, being 1.2 to 1.4. Maybe then you're going to compromise on the dwelling on that property. Option 2 is just keep saving and buy a $2 million property in the desired location by the end of 26, beginning of 27. And number 3 is invest interstate, buy something in Brisbane or Melbourne. Okay, so I've spoken in the podcast a number of times about, buying that forever home or getting into the location that you want to be in as soon as possible. And the reason for that is ultimately it's going to be an asset that you're going to need to use after-tax dollars to pay for. So it's not just a pure investment asset. And so the sooner we can get into that market, probably most likely the better off we'll be, given that property prices obviously trend higher each year over time. So in BM's situation, the key goal is how do I go and buy that $2 million asset as soon as possible? Buying $1.2 to $1.4 million asset, which is option 1, or buying interstate, which is option 3, actually doesn't really help me achieve my goal. It does in a roundabout way, but I'm still going to make some compromises, either in terms of transactional costs and capital gains tax, if I invest interstate and sell, or if I'm going to just try and squeeze a strategy into a particular budget. So obviously, BM, their family situation, they've got good equity, good income, obviously good cash flow management. They've got young kids, so that, with daycare and all that sort of stuff, they've got unusually high expenses, so that those expenses won't persist forever. So they are really in a great situation. You can conceptually, they'll be able to buy that $2 million property within the next couple of years. So therefore, that should be your focus. Whereas the only time I would choose alternate options is where I couldn't foresee a person's financial situation changing so that we could actually pursue the right strategy. So that is the only time I then go, okay, let's adjust the budget and buy something else in Sydney, or let's invest interstate. Is if, for example, BM said, oh, look, we're on very limited income, we're probably never going to get there in terms of that $2 million property. But quite clearly, they will. And BM's talking about option 2, which is, by at the end of 26 or the beginning of 27. And that's the option I would pursue, because I think there's got to be a balance between not procrastinating and trying to implement your strategy as soon as possible, but also having patience and not compromising. And, if it takes you 1 or 2 years to get to where you need to be and pursuing that path is a superior path, it's not that big a deal. Right? You're not going to look back in 30 years and go, oh, we missed the boat by 2 years. You're actually never going to look at it that way. So really, we really must have discipline as investors to, it's great to be very keen to take proactive steps, but you can't be over keen to do that. And sometimes, I'll share my personal experiences. Sometimes I have at times said, okay, this is where I want to be, or this is what I want to do, or this is the asset that I want to invest in, whatever it is, right? And I might say, oh, I want to do that in the next 3 years. At the time that I'm thinking and setting that goal, I might not have a clear path on how I'm going to get there, but I know that's where I need to head. And so therefore, every subsequent decision is then in line with that particular goal. And it's a bit of a funny one. It's a little bit like, every time we've upgraded the home, it seemed like, that's just too much debt. It's very risky, et cetera, et cetera. It always works out and you make it work out. So I know it's not very evidence-based approach. I mean, it is because that's the approach that I've used, but it's not really rooted in the normal logic and numbers that I sort of talk about. But it really is important that if we decide this is the best approach, that you stick with that approach. The only other thing I would say, BM, is if you've got an asset that is mostly building value, and I think you're thinking about it the right way, you're saying, let's have two assets that are going to be heavy land value assets. And the way that I've read it is that you will move into that asset. So excuse me if that's wrong. If it's going to be a pure investment property, then that's fine. But if it is actually going to be a home as well, so that is you own two sort of land heavy assets, one being your home and one being investment property, the other thing you could do is sell your existing asset. I mean, if you've identified that it's not going to be, it doesn't have the fundamentals to drive good long-term capital growth, then actually from a financial perspective, you're probably better off divesting of that asset and then buying a good quality asset. And maybe that's the answer here. Instead of, holding, and I don't know what the answer is in your situation, whether your existing home is you happy to live there, or these two properties, these two $2 million properties that you speak of, investment or part investment, part own and occupy. But in your situation, maybe what you're better off doing is actually, over the next couple of years, sell your home and go buy something for $3 million. So even better land in terms of land quality and land location and so forth, and occupy it as your home. And it's kind of a quasi investment and home. I always talk about trying to take an investment lens to a home purchase, but that could be something that you could toy with, on the idea that if you then did need the equity, and you probably won't because you'll probably have enough super, and if you invest in ETFs and shares, and then if you have one other property, that's probably enough. But if it's not, in the worst case scenario, it's not, you could always downsize in the future. Anyway, just something to think about. At least then you're not going to pay capital gains tax on one of those assets. But thanks for writing in, BM. Hope that helps, and all the people that are in a similar situation. Okay, next question is from Jared. Jared writes, I love the pod, listen weekly, and have received some incredible advice from you, and love listening on the old episodes to get a grasp on different things and as scenarios pop up in life. I know you can't give me specific. Oh, so thank you very much, Jared. That's great. It's funny, actually, some of those older episodes. In fact, I only started recording the podcast about 5 years ago, I think, but there was a whole bunch of blogs that I've written previous to that that are probably worthy of redoing in the podcast. And actually, one of those ones came to light the other day, which is how bad does a investment property need to be to warrant selling it? So because of transactional costs and risks of, buying another dud asset or not buying a perfect asset, of course, if there's only a small difference in capital growth rate between the asset you have, so you've got something that's not perfect, but it's okay, what's the difference between, how bad does it have to be for you to sell it? So I did that before I started this podcast, and I'm going to redo that episode and redo my numbers on that. Anyway, I'm getting sidetracked. I need to get back to Jared's question. So I know you can't give me personal advice. That's true. Of course, only information in the podcast, but my family and I are in a bit of predicament and don't know what to do about it. I hope you can help. We built our first home in 2019 in a small estate close to Geelong CBD for around $430,000 and have experienced some great returns very early on in that property. The property is now valued at $800,000 with $600,000 owing on it. With record low interest rates and under the advice of Philip Lowe, with rates not moving for 4 years, we decided to buy another property, renovate it, and rent the original property out for now for $650 a week. With combined income of about $130,000 a year, as interest rates went up, we could no longer afford to keep both properties, and we had to sell the finished, renovated house and decide to move interstate, selling at a slight loss. With Brisbane and Melbourne/Geelong market set to boom, I'm unsure whether to keep our first house in Geelong for another 4 years to make the most out of our 6-year rule, or selling it to buy our first home in Bribery Island in Queensland. Still with the same income of around 130,000 combined, we cannot afford to buy a second property here and keep both. Also, we've been told from our broker that we cannot refinance due to earnings and interest rates still being high, and with no real wage increase coming up. Do we try and sell our original house and get out of rent vesting for now and get back into the booming Brisbane property market, or wait for the ever-eluding property boom that is meant to happen in Victoria? At the moment, properties on Bribie and Geelong are similar price. Okay, and Jared gave me a link to the property in Geelong so I can see where that is. And growing up in Geelong, I grew up in Geelong, so I know the location very, very well. And I didn't live too far from that when I was growing up as a kid, so all good. Yeah, so what would I do? So my answer's not really going to be very useful to other listeners because it really is, well, maybe it is because it shows sort of my approach. So the first thing I think about in this situation is that if we sell in Geelong, as Jared alluded to, he's not going to pay any capital gains tax because he's got that 6-year rule. So if we sell in Geelong and buy in Bribie Island, my first concern is if we don't do that now, will there be a difference in growth rates in those two markets? And then I've got to pick up the difference from an after-tax cost perspective. So, if Geelong grows slower than prices in Bribie Island, and there's as a result $100,000 price difference, then that's got to come out of my pocket on an after-tax basis. And that can kind of cost you a lot in terms of opportunity cost because it means I've got less to invest, I've got less to put into super, all those other things. So that's the first thing that jumps to my mind. So then the next step then for me is to look at the asset that I've got in Geelong and work out what do I think of the relative, because I need to think about what are the markets going to do and then how does my property fit within that market. So if I'm thinking about Geelong, and I'm going to come back to that in a second, but is it a great property in Geelong or is it in a compromised location? So if I think about Geelong too, and I guess it's similar for other regional locations around Australia, the interesting thing, we've had conversations about this inside our business as well, is that when we look at data over the last 10 years, it's going to be heavily skewed as a result of what happened through COVID. And I think some buyers agents are using that data to their advantage as well to get people to invest in more affordable markets, so regional markets. But the reality is that that was a once-off sort of spurt of, the COVID impact in terms of people saying, oh, we don't need to live in the city, we can work from home now. And then the second impact of much lower interest rates. We'll almost never see those interest rates again unless we have another pandemic, touch wood. So we've got to be really careful about looking at the data. And I guess that's one of the things that I've mentioned before in this podcast. Data is good, but you've got to look behind the numbers and you've got to understand the performance. Because once you understand the performance, you can then decide whether you want to extrapolate that performance over the future decades or whether there needs to be an adjustment. So those regional markets have had a pretty good run over the last 10 years, whereas if I compared the median price in Geelong versus median price in Melbourne, and I looked at it over the long period of time, and I haven't done this, but if I did, I reckon it'd show that there's more relative value in Melbourne than there is Geelong. So yes, I think Victoria will go through a boom, but I think more correctly, Melbourne will, not necessarily Victoria. So therefore, I wouldn't be waiting for, prices to really kick off. And then when I look at where Jared's property is located, the thing that Jared must consider is that it's located on the fringe of Geelong and there's a lot of available land. So there's some new estates in the area and there's a lot of available land. I actually know just from family connections that there's a highway relatively close by, so the Geelong bypass. And the other side, I know a lot of that land is owned by one particular family that is reluctant to sell, but if the price is right, they'll sell. So I think Geelong's going to keep spreading out as Melbourne does. And so that's going to be a problem. Whereas if Jared's property was closer to the CBD in suburbs like Newtown, for example, West Geelong, those sorts of suburbs, even, the sort of northern side of Belmont, for instance, or Highton, those sort of more established suburbs, I'd be inclined to probably keep it. So I think because of the location of the property in terms of its proximity to available vacant land, and then because Geelong and regional areas have had a relatively good run over the last 10 years relative to Melbourne, and that says to me that Geelong could kick off, and in a rising tide, all ships rise, and as property rises in Melbourne, Geelong starts to look even better value as well. So I'm not saying it won't be impacted by a recovery in Melbourne, but I wouldn't be necessarily waiting for it. As a result, I think I would sell the Geelong property and go and buy your family home in Bribery Island. Okay, I might leave it there for today. Just a reminder, prosolution.com.au/YouTube, or the link is in the show notes for you to register for the event on the 28th of May, that YouTube live event. And until tomorrow, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.